Have you ever stared at a stock chart and just seen a bunch of random chaotic lines? Well, today, we're going to crack open the essential toolkit that analysts use to turn all that noise, all those prices and returns and volumes, into a story that actually makes sense. Let's dive in.
And this right here, this is the core problem, isn't it? At first glance, market data just looks like pure chaos. But somewhere in all that noise, there's a signal, there's a pattern, there's a story. Our whole goal is to find it. And to do that, you absolutely need a structured approach.
So the first thing we need to do is just get our bearings. Before we can understand the journey the data is taking us on, we have to figure out where we are right now. Think of this first set of tools as our compass. It's all about finding the central point of our data. Now, the fancy term for this is central tendency, but don't let that through you. It's really just the first step in orienting ourselves. It's a single number that tries to give us a feel for the data's location, its typical value.
Okay, so to find that center, we've got two main players, the mean and the median. The mean is just your classic average. The thing is, it gets yanked around by extreme values. Now, that's actually super useful if volatility is exactly what you're trying to measure. But the median, that's just the value smack dab in the middle. It's way more resistant to those crazy price swings, giving you a much more stable idea of what a typical day looks like.
Okay, so we've found our center point. Awesome. But that's really only half the story, right? How wild is the ride going to be? To figure that out, we need to measure how spread out everything is. This next part of our toolkit, think of it as our risk meter. I mean, this is the real question, isn't it? Is all our data huddled up tight around that center point, or is it scattered all over the place? This measure of what we call dispersion is basically our best way to get a handle on variability, and in finance, variability means risk. And we figure this out in a few logical steps. First, we just glance at the range. Super simple, just the highest value minus the lowest. Then we get way more serious with variance, which is the powerhouse behind most risk models. But the one you'll hear about constantly is standard deviation. It takes all that power from the variance and puts it back on a scale that we can actually relate to our data. There's a reason this is the king of metrics in finance.
All right, so we've got our center, we've measured the volatility, we should be good, right? Well, not so fast. That still doesn't tell us the whole story. What if the data's all lopsided or hiding some nasty surprises? For that, we need to break out the third part of our toolkit, our X-ray goggles, so we can see the data's true shape. And you gotta understand, this is so important. You can have two different stocks with the exact same average return and the same standard deviation, but they could have wildly different risk profiles. We have to dig a little deeper and look at the symmetry of the data and its potential for those really extreme, out-of-nowhere events. And this is where two really cool metrics come into play, skewness and kurtosis. Skewness, on the left, tells you if the distribution is leaning to one side. A negative skew, for instance, often means there's a bigger chance of a large downside move, something you definitely want to know. Then you have kurtosis, on the right. This measures how fat the tails of the distribution are. Think of high kurtosis as a big red flag that those extreme black swan events are way more likely than you might think.
So we've crunched all these numbers. We have our mean, our standard deviation, our skew. Now what do we do with it all? Well, the final and most important step is to bring it all together so we can see it. We need a blueprint that tells the entire story in a single glance. The number one tool for the job is the histogram. It's such a simple idea, but it's an incredibly powerful picture of everything we just talked about. You can see the shape, you can see where most of the data is, and you can see what's happening way out in the tails. Here's a super simple way to think about it. We just take all our data points and sort them into bins, like low, medium, and high. Right away, you can see that, hey, most of the action is happening in that medium bin. That's the basic idea of a histogram. It shows you the density and shape of your data. But if you want the most bang for your buck, the most information packed into the smallest space, nothing, and I mean nothing, beats the box plot. It is an absolutely brilliant tool that summarizes so much of our analysis in one clean image. It's just amazing how much this one little graphic tells you. See that line in the middle of the box? That's our median. The box itself, that's the middle 50% of all our data. The lines, the whiskers, show the typical range. And, maybe most important, see those little dots floating by themselves? Those are our outliers. It's almost our entire analysis all in one picture. And speaking of those little dots, the outliers, this brings us to maybe the most critical check of all. What do we do about them? It is so tempting to just say, that's a mistake, and just delete them. But that can be a massive, massive error. Look, an outlier could just be a typo, a data entry mistake. It happens. But it could also be a signal. It could be a genuine, incredibly important market event. That one little dot might just be the most valuable piece of information in your entire dataset. And that leads us to this really important takeaway from the source material. Simply getting rid of outliers, what it calls mechanical removal, well, it destroys information. A great analyst doesn't just delete outliers, they investigate them. They try to understand the story that outlier is trying to tell them.
And just like that, we've done it. We started by finding our center with the compass. We measured the risk with our risk meter. We put on our X-ray goggles to see the hidden shape. And finally, we drew the blueprint to tell the visual story. Your Analyst's Toolkit is officially assembled. So that's the framework. That's the toolkit. It's a fundamental way to make sense of any financial data you come across. The only question left is, what are you going to do with it? What hidden stories are just waiting out there in the noise for you to find? Now go uncover them.